Hello, this is Professor Ramakrishna, Professor of Finance at one of the leading business schools in India. Welcome to my YouTube channel, Archiversity. And also, when time permits, visit my website, that is archiversity.com, to download playlists of different courses in finance, accounting, and analytics. Since inception, and by the time I am creating this video, this is around 15-16 months, and during this period near about 2 lakh students or 200,000 students from all over the world watched my videos, and on an average of 20 hours a day. So this is really amazing because at a regular workplace I teach hardly 3 to 4 hours a day. However, through online to digital platform I am teaching 20 hours a day for the students and practitioners like you from different corners of the world. This is very happy for me. Now, in today's lecture, or in this lecture, I am going to explain you the basis of accounting. So when you talk about a basis of accounting, there are two different classifications. One is cash basis of accounting, and second one is accrual basis of accounting. First, I'll explain you who are supposed to use these two, and how actually this is done, and when it is required, and what is the difference between these two methods, and how important these two are for an accounting professional. The accounting methods or basis of accounting or accounting methods broadly classified into one is a cash basis and second one is the accrual basis. Now, any public limited company or a private limited company is supposed to prepare its accounts on the basis of accrual basis accounting. On the other hand, sole proprietorship, not-for-profit organizations, they can prepare their accounts on the basis of a cash. But generally, when we are talking about accounting as a profession, we are talking about a public limited companies or a large organizations. And another aspect is that as we are following the principles of generally accepted accounting principles, that is US GAAP, IFRS or Ind AS, in all those scenarios, the criteria for preparing accounts is the accrual basis. So how these two differ is accrual basis and cash basis is based on three different accounting principles. One is a revenue recognition principle. Then we have a accounting time period principle, and based on which we have a matching principle also. So based on these three principles of accounting, we can easily differentiate these two methods, that is a cash basis and accrual basis. So first we look at a cash basis of accounting. And when you're talking about the two items, that is the revenue and expenditure. So in cash basis, revenues are recorded when they are received. When a cash is received, we record. And similarly, expenses are recorded when they are paid. Suppose on December 31st, you made a sale and received cash of $1,000. So as you received cash, in the cash basis of accounting, we record this transaction. Similarly, on December 31st, you made a purchase and paid cash. So we record this, in the sense you purchased $500. So we record this in the sense to recognize your expenditure and revenue in cash basis. In this case, the cash is to be paid or received. In simple terms, the cash is to be paid or received. So when it is a paid or when it is a received, then only it is entered in a cash basis of accounting. On the other side, or on the other hand, we have a accrual basis of accounting. So in accrual basis of accounting, we record revenues when they are earned, irrespective of cash is received or not. Similarly, when it comes to the payment of expenses, we record expenses when they are incurred. Again here, whether you received or whether you paid or not, that is immaterial. So that is here revenue is recognized. This belongs to our accounting concept of a revenue recognition. Then expenses are incurred, so expense recognition. And another is your matching principle, in a sense, and matching and time period principle. So all the expenses or revenues related to that particular time period need to be recorded irrespective of cash is received or not. We'll go to the same example here. Let us say on December 31st, you made a sale of $5,000. So in this, you have a cash sales of $2,000 and a credit sale of $3,000. So your total sale is $5,000. So according to our accrual basis of accounting, we recognize total $5,000 as a sale. That means 2,000 is the cash received and remaining 3,000 is to be received, that is your receivables. So both are assets, cash is asset and receivables are asset, and total 5,000 is shown. That is the revenue is recognized when it is earned. However, in case of if we are following only cash basis, then we record only 2,000 because this is only 2,000 amount that we receive the cash. So 3,000 will be recorded in future time period when we receive the cash. Similarly, if you have expenses, let us say on on December 31st, you purchased goods worth $3,000. So in this, you paid $1,000 as a cash and your credit purchases are $2,000. So our accrual basis of accounting recognizes the $3,000 as a purchase. Here 1,000 is a cash paid and 2,000 is a credit which is to be paid, that is a payable. So both, that is payable is a liability. We show that we have to pay this amount. If it is only a cash basis, then we show only $1,000 as a expenditure. Now why this is required is according to our time period concept. So we are preparing an accounting year for a particular time period. Let us say January 1st to December 31st. I'm just giving you an example of accounting year. So each country has got different accounting years to be followed, assuming that our accounting year is from January 1st to December 31st. So during this period, so this concept is your accounting period or a time period concept. And next is during this time period, we have to recognize our revenue. Recognize our revenue. That means, let us say during this period, we generated sales of $100,000 is a revenue that we generated. So this is a revenue recognition. Whether this revenue may be in the form of a cash or in the form of a credit, that is not material here. Simply whatever the revenue that is generated, this is a second one is a revenue recognition, and third one is our matching principle. So according to our matching principle, what we need to do is all the costs incurred to generate this revenue need to be matched. That means, let us say for this to generate this 100,000, we spent $50,000 as expenses. So again, these expenses, whether expenses paid or expenses payable, it doesn't make any difference. So these three principles, that is a time period, revenue recognition and matching principle, plays an important role in accrual basis of accounting. So in case of a cash basis of accounting, simply we recognize that whenever the cash is received and when the cash is paid. So have a clear understanding of this, and whenever you are writing accounts or you are preparing accounts for public companies or private companies or larger organizations, keep this in mind that the accounting is or the accounts are prepared on the basis of accrual system or accrual accounting method. For small organizations and not for profit organizations, they may consider the cash basis of accounting. So in my next lecture, I am going to explain you the differences between cash basis and accrual basis with a series of examples. So it is kind of an activity. When previously I performed one activity on classification of accounts. Similar to that, in my next lecture, I am explaining this activity on how to identify the accrual, whether how to identify or how to treat accounts in cash basis and accrual basis. So keep watching. So next video is classified as basis of accounting activity. Thank you for taking your time and watching this lecture. Hope this is somewhat helpful to you.